Welcome back to the deep dive. Today, we are putting on the hard hats. We're going deep into the core plumbing of decentralized finance.
Yeah, we're not just talking definitions today. We're really dissecting the engines that are driving all this volume, the DXs and, of course, the AMMs that make them all work.
And our mission here is really practical. We want to pull out the key insights from the biggest players out there. We're talking Uniswap, SushiSwap, Balancer, Curve, and Bancor.
Exactly. And understanding how they handle things like capital efficiency and risk, especially risk, and how they're adapting to layer 2, well, that's pretty much the most important thing you need to know if you follow the space seriously.
Right. And we don't really need to spend time on the whole DX versus CX debate. I think you get the core idea. It was all about getting rid of that third-party risk.
You're not trading on a platform that holds your keys anymore.
No, you're trading directly with a smart contract. It's a fundamental shift.
It is. But that shift, moving from trusting a company to trusting code, it created a huge problem. How do you make sure there's always a buyer and a seller if you don't have a traditional order book?
And that's where the liquidity pool-based DAX came from. That's the innovation.
That's the one. And that's where the AMM comes into play.
So let's start there, because that's really where the magic happens. What exactly is an AMM, and why did it just completely take over from the old order book model?
Well, at simplest, an AMM is just a smart contract that holds a bunch of tokens. That's your liquidity pool.
Okay.
And it completely flips the old model. Instead of peer-to-peer where you're waiting for another person to take your trade.
Right, you're waiting for a match.
Exactly. Now it's peer-to-contract. The AMM uses a mathematical formula to set the price, and it does it automatically, 204.7.
And the people who put their tokens in the pool, the liquidity providers, or LPs, they're basically just lending their assets to the contract.
They are, usually in a 50-50 split by value. And in return, they get a small piece of the fees from every single swap. They're the ones making the whole machine run.
And the success of that machine, it all comes down to that one formula at the core.
It really does. And the most famous one, the one that basically launched DeFi as we know it, is the constant product market maker.
Ah, the classic $6 times equals dollars. So for you listening, what is the single biggest takeaway from that formula? I mean, Uniswap and Bancor made it famous.
Its greatest strength is, funny enough, also its greatest weakness. And that's the guarantee of liquidity.
What do you mean by that?
Because the product of the two tokens has to stay constant. The pool technically always has assets to trade, no matter how crazy the price gets.
Yeah.
But that comes with a cost. It means huge slippage on big trades. And most importantly, it creates the risk of impermanent loss.
Which we will definitely get to. But that brings up the opposite example, the second type, the constant sum market maker.
Right.
On paper, this one sounds way better. Zero slippage, a straight line price curve. What's the catch?
The catch is that it's a disaster in practice. It's incredibly vulnerable to being completely drained. If the price in the pool is even slightly different from the market price on, say, Binance,
arbitragers will just step in
instantly, and they will completely empty the pool of whichever asset is cheaper. It's just not a workable model for volatile assets.
So the market needed something more specialized, which brings us to number 3, the constant mean market maker. This is Balancer's big innovation.
Yes. And this is where things get really interesting. Balancer looked beyond just simple two-asset swaps. By keeping a weighted geometric mean constant, they allow pools to act more like customizable index funds.
So more than 2 tokens.
Way more. Up to 16 tokens in their V2. And you could set the ratios yourself. Doesn't have to be 50-50. You could do an 80-20 pool if you wanted. It's like building a portfolio strategy directly into a smart contract.
And then you have the ultra specialist, the 4th one, the stable swap invariant from Curve Finance.
Yeah. The king of stablecoins.
This one is a hybrid, right? Built for one job and one job only, keeping the price as stable as possible.
That's it. The formula is really clever. It acts like a constant sum model when the pool is balanced. When prices are hovering right around 1-to-1, like DAI and USDC should be.
Okay.
But if the pool starts to get imbalanced, it slowly blends in the constant product curve to provide that liquidity backstop. It's why Curve is just the undisputed champion for trading assets that should have the same value. The slippage is tiny, and impermanent loss is almost a non-issue.
And you brought it up earlier, so let's dive right in. The single biggest risk for anyone providing liquidity, impermanent loss, IL. Even the name is a little tricky.
It's the great paradox, isn't it?
Yeah.
The loss is only impermanent because it only exists on paper. until you withdraw.
Explain that. So it happens when the dollar value of my tokens in the pool is less than what they'd be worth if I had just left them in my wallet.
Exactly. And the loss only becomes real or permanent when you pull your liquidity out before the price ratio swings back to where it was when you deposited.
And this isn't a small risk. The numbers are pretty stark. A 2 times price change in one of the assets. That's a 5.7% loss compared to just holding.
And if it's a 5x price change, you're looking at a 25.5% loss. But here's the statistic from our sources that really just stops you in your tracks.
Go on.
Roughly 50% of the users providing liquidity to Uniswap v3 actually see negative returns overall.
Wait. Negative returns even after counting the fees they earned?
Even after the fees. It just goes to show you that being a passive LP is often a losing strategy unless you really know what you're doing.
So half the people on the most advanced AMM would have been better off just holding their assets. That's more than just a risk. That feels like a structural problem.
It is. It means you have to be incredibly active in managing your position, or you have to stick to very safe pairs. And we've seen what happens when things go really wrong.
I think we all know the example, the LNA UST collapse.
The ultimate nightmare scenario. When LNA went from $80 to basically zero, the AMM didn't stop. It just kept rebalancing.
Yeah. So it was forcing LPs to sell their good asset to buy more of the worthless one.
Exactly. It was like an automated instruction to catch a falling knife all the way down. People lost over 99%. Even before that, the Sushi Weth crisis in 2020, where Sushi dropped 80%, LPs lost over half their capital. It's brutal.
So, okay, the risk is clear. How do you mitigate it? Besides the obvious, like pairing stablecoins or highly correlated assets like Bitcoin and Ethereum, how are protocols actually building solutions for this?
Well, the protocol that really made this its core mission is Bancor. They basically decided that the only way to solve this was with insurance.
Their impermanent loss insurance.
Yep. It's funded by taking about 15% of the trading fees. And what it does is it guarantees you a minimum value when you withdraw.
But there's a time lock, right?
There is. You have to stake for at least 100 days to get the full protection. But that promise completely changes the entire risk calculation for an LP. You're trading some potential upside for guaranteed protection.
The fact they even needed to build insurance says it all. Okay, so let's zoom out and look at how these 5 big players have built their own moats. We'll start with the original giant, Uniswap.
Uniswap v3 is all about one thing: capital efficiency. They threw out the old V2 model where your money was spread out across all possible prices.
Right. And they brought in concentrated liquidity. So now LPs can say, I only want to provide liquidity for ETH between, say, $2,000 and $3,000.
Precisely. Your capital is working much harder, so you can earn way more in fees. But it's also much more complex to manage. And your position is so unique that it's actually represented by an NFT, not a standard token.
And V3 also brought in different fee tiers.
Right. 0.05% for stable pairs, up to 1% for really exotic, volatile stuff. More flexibility.
Okay, so on to SushiSwap. The famous fork, the vampire attack. What makes them different today?
Today, I'd say it's their reach and how they reward their community. Sushi's on like 9 different blockchains. It's a true omni-chain hub. Uniswap is much more focused on Ethereum and its main L2s.
And the tokenomics are different. They share the revenue.
Yeah, that was a huge deal. They charge a 0.3% fee, but a piece of that, 0.05%, goes directly to people who hold and stake the SUSJ token. It creates a direct reason to hold the token, which UNI didn't have at the start.
Then there's Balancer, we touched on it, the investment manager.
The flexibility of that constant mean formula is their superpower. But they're also famous for a very specific tool called liquidity bootstrapping pools, or LBPs.
Right, for token launches. The price starts high and then goes down over time.
And that design is all about making launches fair. It discourages the big whales from just coming in and buying up the entire supply in the first 5 seconds. It gives smaller retail users a real chance to get in at a decent price without getting front run.
Okay, Curve Finance, we know their game. Low slippage swaps.
And they are just ruthlessly efficient at it. They use these super deep base pools, like the famous 3CRV pool with DAI, USDT, and USDC. Then they use what they call meta pools to link other less common tokens to that core liquidity.
So the main pools stay incredibly strong.
Incredibly. And they also have this cool fee model where LPs can earn in 3 ways: trading fees, rewards from Curve, and also yield from lending out those same stable coins on other protocols like Aave or Compound.
And we finish with Bancor, the IL protector. We mentioned their insurance.
Yeah, and the other big feature they pioneered was single-sided staking.
Oh, right. So you don't need a pair of tokens.
Nope, you can just deposit one token, say ETH, and the protocol handles the rest. It makes it so much simpler for people to participate, and you still get that IL protection after the 100 days.
This all leads to the next big challenge, right? Scaling. Doing any of this on Ethereum mainnet is it's incredibly expensive.
That's why the entire industry has made this massive push to layer 2 solutions. It's all about crushing those fixed costs. I mean, the gas fees on mainnet were just killing any chance for retail to participate.
The cost difference is actually insane when you look at the numbers.
It's staggering. The median swap cost on Ethereum mainnet can be, $10 or more. On an L2 like Arbitrum, that same swap costs around 28 cents.
That's a 97% discount. It just completely changes the entire economic calculation.
It really does. For the average person swapping on Uniswap, something like 90% of them get a better deal on an L2 once you factor in gas. The only time mainnet makes sense is for massive trades. The break-even point is somewhere between $25,000 and $125,000.
So the takeaway is, unless you're a whale, L2s have basically made transacting on Ethereum mainnet economically irrational for most people.
And for LPs, it's a huge win too, especially with Uniswap v3. Lower gas costs mean you can adjust your concentrated liquidity position way more often to stay in the most profitable range.
Boosting that capital efficiency we talked about?
Massively. The data shows liquidity is at least 75% more concentrated around the current price on L2s compared to mainnet. And because the costs are so low, arbitrage bots can operate more efficiently, which means LPs on L2s actually earn about 20% more from arbitrage fees.
But L2s aren't perfect. Not yet. There's still some pretty big trade-offs.
Yeah, there are 3 big ones right now: centralization risk, fragmentation, and bridging time.
Okay, break those down.
Right now, the sequencers on these rollups, the things that order the transactions, are centralized. That's a single point of failure. Second, all the liquidity is split up across Arbitrum, Optimism, Polygon. They don't talk to each other natively.
And the third one is a real user experience headache, getting your money back.
Exactly. If you want to move your funds from an optimistic rollup back to Ethereum mainnet, you could be waiting up to 7 days. That's a huge problem for active traders.
Okay, let's wrap up by looking at where Uniswap, the pioneer, is headed next. There's governance, and then there's V4.
The governance proposal is a massive deal. It's about activating the fee switch.
Right. The proposal to create DUNI, a legal entity, so the DAO can actually turn on protocol fees without taking on massive regulatory risk.
And if that passes, UNI governance could vote to divert a slice of the LP fees, a tenth, a sixth, whatever they decide, away from LPs and to the protocol itself.
And the plan is to use that revenue to burn UNI tokens.
That's the proposal, a direct supply reduction that benefits every single UNI holder. The market loved it. The token jumped over 35% on the news. It just proves that protocols generating real cash flow is still the most powerful narrative.
And then there's the big one, the architectural revolution of Uniswap v4. It's all built around this idea of hooks.
V4 is designed to turn the DX from just a swapping tool into a fully programmable platform. Hooks are literally what they sound like. They let developers attach their own custom code into the life cycle of a swap.
So you can build things like limit orders or automatic rebalancing strategies directly into the pool itself.
Exactly. Or custom oracles. It makes the whole thing modular. And it's paired with huge gas savings. First, there's the singleton design.
Meaning all the pools are managed by one master contract.
Right. So creating a new pool isn't a whole expensive new contract deployment anymore. It's much cheaper. And the second part is flash accounting, which basically nets out all your trades in a complex swap and only settles the final balance change, saving even more gas.
So this whole deep dive really confirms that DeFi isn't one big market. It's a bunch of specialized niches. You have Bancor solving for risk, Curve solving for stablecoins.
And the one thread connecting all of it is that relentless push to get rid of fixed costs. The entire future of this space depends on layer 2 scaling, making things cheaper and more efficient for everyone.
We've covered the core formulas, the pretty extreme risks, how the big players differentiate, the L2 scaling boom, and the future with V4. But it does leave us with one final provocative thought.
We know L2s offer better economics for almost everyone, but right now, that comes with the trade-off of centralized sequencers. So here's the question for you to think about. If that centralization risk gets solved over the next few years, is there any economic reason left for the average person to ever transact on Ethereum mainnet again? Or does all meaningful DeFi activity just migrate off-chain for good, leaving mainnet as nothing more than a settlement layer?
Something to keep an eye on as this all unfolds. Thanks for joining us for the deep dive.